QuickBooks Pro Desktop 2021. Purchase fixed asset on account with foreign currency. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our problem 4 practice file. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. We're now going to record the purchase of property, plant, and equipment, fixed asset. We're going to be purchasing it on account, meaning we'll be paying for it in the future. Not only that, but we'll be paying for it not with our currency, which is going to be the US dollar in our case, but rather the foreign currency, in this case being the Australian dollar. Let's take a look at that first in Excel. So we'll see Excel be a little bit more transparent for us to see the calculation. Then we'll move back on over to the QuickBooks file. So we're going to say that there was a purchase of furniture and equipment. It happened on 12/1/X1, and we're going to be paying for it in the future for 100,000 Australian dollars. So we need to record this on our books in terms of the US dollars. So what we're going to do then is the transaction will be straightforward. We'll say this is going to be an asset here. So we're going to say it's going to be a depreciable asset, and like property, plant, and equipment, machinery, or something like that. And then we're going to say the credit then is going to go to an accounts payable, but it's going to be a special accounts payable for AUD. We're going to label it because it's going to be paid not in US dollars, but in Australian dollars, even though we're going to have to value it on our books in the US dollar. So then we'll do our calculation. Let's do it first with the trusty calculator. So I'll pull out the trusty calculator. We're going to be taking the 100,000 that we're going to be paying in foreign currency. We're going to use the current spot rate. Notice we're not using the forward-looking rate. We're using the current spot rate here to record the depreciable asset, even though we're going to be paying for it at some point in the future. We're thinking like in 120 days, right? So I'm going to say multiply times the 0.6, and that's going to be the 60,000 we're putting it on the books for. So this is going to be equal then to the 100,000 that we're going to be paying for it in the future times the current spot rate, not the forward rate. And there we have it. There's the debit, there's the credit. Let's record it on out. If we record it on out, we're going to say that this is going to be the depreciable assets is going to be on the books for the 60,000, and then the payable here and the Australian dollars will be 60,000. Now this although we're paying 100,000 units of foreign currency, Australian dollars, we put it on the books at 60,000 for the payable at this point in time. And then this item, which is the fixed asset, is on the books at 60,000, meaning the dollar equivalent of what we're going to be paying as of today, basically the spot rate. Now, there's going to be a variance between the rates here that we'll be taking a look at in the accounts payable. That's where the risk factor lies. And that difference then is not going to change the depreciable asset, the cost of the depreciable asset, but rather we'll be recording that change and then the difference to a gain or loss down here. That gain or loss, or the potential of a loss, is what will then lead us to do our forward contract, which can hedge the risk of a potential loss. And so we'll see that in a future presentation. So what do we need in order to record this in our QuickBooks system? We're going to have to set up an account, of course, for property, plants, and equipment. That's fairly straightforward. We're going to have to set up the foreign currency, which we already did. We'll take a look at that again because we need the Australian dollar currency. In order to set that up, we need the exchange rate so that we can put the proper exchange rate, which we're going to have to put in here at the 0.6. We're going to set up a payable account that's going to be in Australian dollars so that we have that linked up, and we're going to need a vendor that's going to be set up in Australian dollars, meaning that vendor is one that we pay in the foreign currency. Then we can enter basically our transaction, which in essence will be a bill here. So let's go on over and say, okay, we're basically entering a bill, in QuickBooks. But in order to do that, we had to set up our currencies. So to do that, we turned on the currencies by going to Edit, Preferences, Multiple Currencies, Company Preferences, then turned on the currencies, noting that once done, you can't turn it off in the company file. And then we go down to our lists, and we need the currency lists that are now available to us. We then turned on the Australian dollar, because that's what we're going to be using, by going to this little checkbox and then finding it and right-clicking on it, and we made it active. If I did it now, it would make it inactive, but we made it active. And then we're going to go down and I'm going to uncheck that so we have just the current currencies there. Then we could, if we were doing this in real time, get the spot rates by going to the activities drop down, rise up, and we're going to take and download the latest exchange rates. and then we would have that. But because this is a practice problem, we're going to have to manually put the rate in there. So I'm going to double click on the Australian dollar here, and this is going to be as of 12/1. I'm going to say it's as of 12/01/21, and the rate we're going to have is that 0.6. So there we have it. So now we have the rate in place. I'm going to say OK on that. So that's good. Then we need our accounts to be set up. So I'm going to go to the lists drop down, take a look at our chart of accounts. We need a property. We need some kind of fixed asset. I don't like just calling it a depreciable asset here. I'm just going to call it like a machinery maybe. So I'm going to go to the accounts drop down, rise up, and then we're going to go to the new item, and we want to make it a fixed asset type of item. We're going to go ahead and continue. Notice there's no option here in this particular account to set it up as a particular type of currency because it will be measured in US dollars. So this is not going to be something that will change in terms of the type of currency. We're not going to say this is a fixed asset in Australian dollars because we're keeping our books in the US dollar. So it is what it is. So it's going to be a fixed asset. Let's call it machinery and equipment. Machinery and equipment. That looks good. I'm going to save that. Next thing we need is an accounts payable account that is going to be set up for foreign currency. So, and that one will have an option for foreign currency because we need to tell the system, hey, look, we're actually paying this in Australian dollars, even though like we don't normally do that because we use the. So anyway, so then we're going to go to the accounts drop down, rise up, and we're going to say new once again. And this time we want an accounts payable account, accounts payable, and then continue. And then we want this accounts payable. Here's the little thing that says, do you want it in US dollars, which is the default? And we're like, no, this one's in Australian dollars, the AUD. So I'm just going to call this accounts payable and then AUD, Australian dollars. Australian dollars. Okay, and then that's what we need there. So I'm going to set that up. Say save that, close it, please, por favor. Close that out here. And then close this out here. And then we need a vendor. We need to set up a vendor, which we could do while we set up the bill. But I'm going to set up the vendor in the vendor center because I'm emphasizing the fact that we need to make it a vendor that we pay in foreign currency. In this case, of course, that foreign currency being Australian dollars. So I'm going to go to the vendor dropdown, then go to the vendor center, And then I'm going to hit the new vendor dropdown, new vendor. I like saying the vendor center. So that's got a good rhythm too. But in any case, this is going to be vendor, and I'm just going to call it AUD. Let's call it vendor 1, AUD, just to emphasize the fact that it's going to be in the Australian dollars. We're going to change this here to the Australian dollars. That tells QuickBooks, hey, look, this vendor, we pay them in Australian dollars. So then we're going to say, okay, and that's good. Closing this back out now, we can do what we've been waiting to do and enter the bill. We're going to enter the bill. So we're just going to enter the bill. Now, when we enter the bill, that's going to increase the accounts payable. That's what a bill does. We just want to make sure it's the correct accounts payable. We want the accounts payable for the AUD. So accounts payable in Australian dollars. We're going to pick our vendor, which we set up as vendor 1, AUD. Date's going to be 01. I'm sorry, it's not 01. It's 12/01/21. And then it says, hey, look, I'm paraphrasing. Hey, look, you changed the date. Do you want us to change the rate for that date? And I'm going to say, yes, okay. And then it should change the spot rate. So now let's go. And so here it is, 0.6 now. And then we're going to say in Australian dollars, we're going to be paying 100,000 Australian dollars. And then it uses the spot rate and marks it off at the US dollars, which is the 60,000, which is correct. Then we just need to put it to the correct accounts down below. The correct account, we're just going to put it into property, plant, and equipment, or the equipment account we set up. Now, I'm not going to track it in equipment items. If you want to talk about item lists and equipment items, we have a section on that or a course on that. You can take a look at that. But here, we're just going to put it into the account of the machinery and the equipment. So what's this going to do when we record it? It's going to increase the bill for the 100,000 that we're going to pay, but it's going to put it on our books for the equivalent value in US dollars, that being the $60,000 US dollars, even though we're paying 100,000 foreign currency units, that being Australian dollars in the future. Other side then, we'll go to the machinery and equipment, it being recorded at the value given this current spot rate, being the 60,000. So it's going to increase for 60,000. Let's go ahead and save it, close it, check it out. So save it, close it, checking it out by going to the reports drop down, company and financial, on down to the balance sheet standard, otherwise known as the standard balance sheet. And then we're going to go to the customized reports up top, changing the dates from 01/01/21 to 12/31/21, and then OK. So there we have it. So the machinery and equipment on the books, 60,000. There's our vendor. That looks good. And then we have the accounts payable on the books for the 60,000. Other side, no effect to the income statement. If I go to the reports drop down up top and we go to the vendor payable and take a look at the vendor balance detail, we then have our vendor here also set up that matches out, the total matches out to what is on our balance sheet. Now, if we go back on over to Excel here, there's one other thing I'd like to set up, and that's going to be these beginning balances. So I'm just going to add a cash account, put 100,000 in there, the other side going to retained earnings, just to have some minimum other amount of balance so we don't have a negative cash amount or anything like that as we go forward. So we'll just put in these beginning balances and set up the checking account. So back to QuickBooks. We're then going to go to the lists drop down. Take a look at that chart of accounts. Here's the account chart that lists all of our accounts. I'm going to go to the account drop down, rise up. We're going to have a new one. And this is going to be our checking account, which is going to be a bank account, continue. And then it's going to be a bank type account. And this, I'm just going to call it checking. And then we're going to call it USD, standing for the US dollar, not to be confused with the Australian dollar that we might set up later. And there it is. It's going to be in the US dollar as the currency value. So I'm going to say save it, close it. Then I'm not going to buy any. I'm not setting up bank feeds, no checks or anything. I don't want to buy anything. Okay, so then I'm going to double click on the checking account, and I'm just going to put this in there as of 01/01/21. And this is going to be a deposit. We'll just put that 100,000 in for like our starting point number. 100,000 deposit. Other side going to retained earnings. If you have something other than a corporation or an S corporation, some type of equity account is what we're looking for here. Might be the capital account, might be owners, might be equity, owner's equity. So I'm going to say tab, and then that's it. Let's set it up, and yes. It's telling us, hey, you're hitting retained earnings, and that we don't normally do that, so we're just warning you. But we're like, that's okay. So we know what we're doing. And then I'm going to close this back out. I think so. We know what we're doing for the most part. And then we'll go back to the reports here. And so there we have it. So now we've got the 100,000 in the checking. We've got the retained earnings. And then we've got the machinery on the books, the accounts payable on the books. One last thing, let's check it out in terms of the trial balance so we can see this without all the subtotals. The trustee trial balance can be found by going to the reports drop-down, accounting and taxes, trustee trial balance right there, the TB, trustee trial balance. We're going to change the dates from 01/01/21 to 12/31/21, and there's what we have thus far. Now, of course, the problem here is going to be this accounts payable affords us some risk. It could change. The value of it is going to change based on the exchange rates, and that gives us some risk, which leads us to then say, maybe we want to have another forward exchange contract that could mitigate that risk. And so we'll continue with that next time.